Imagine a large-scale manufacturing plant that produces boxes of cornflakes. To operate, the factory is split into two distinct operations: a packaging division that creates the cardboard boxes, and a production division that processes the actual cereal. Before a single box of cornflakes can be shipped to a grocery store, the production division must first acquire empty cartons from the packaging division to complete the final product. Because both divisions are owned by the exact same parent company, no real money changes hands. This raises a critical accounting question. How does a corporation determine the price of a good when it is trading with itself? The internal price assigned to these internal goods is called a divisional transfer price. The total real-world profit of the entire corporation is strictly locked based on the final sales volume to external customers. Transfer pricing cannot manifest new revenue out of thin air. Its only function is to dictate how the existing pool of profit is credited to specific divisions on internal performance reports. This diagram illustrates the core equation. Total corporate profit equals final sales minus total costs. While that final profit number is locked into place, the internal division numbers shift back and forth. By calculating transfer prices under two distinct methods, the math will reveal how a specific formula can inadvertently penalize a company's most efficient division. At its core, transfer pricing is a zero-sum game over internal credit. This data matrix displays the financials for an 8,000-carton production run. The total sales to outside customers amount to 3 million rupees. Internally, the production cost is 1,080,000 rupees, and the packaging cost is 80,000 rupees. Before any internal prices are set, we have to determine the absolute maximum profit pool available for this specific 8,000-unit batch. By combining the standalone costs of the production and packaging divisions, the total corporate expenditure comes out to 2,060,000 rupees. Subtracting that 2,060,000 in costs from the 3 million in total sales isolates the actual corporate earnings. The result is exactly 40,000 rupees. That 40,000 rupees is the precise financial pie that the two divisions must now divide. The size of their respective slices depends entirely on the accounting method management selects. The first accounting framework we can apply is the shared profit relative to cost method. The logic is straightforward. A division receives a percentage of the total corporate profit directly equal to their percentage of total corporate costs. This formula layout shows exactly how that allocation works. A division's share of the profit equals their specific internal cost divided by the total corporate cost multiplied by the total available profit. We can plug in the data for the packaging division. They spend 80,000 rupees out of a total cost pool of 2,060,000 rupees, and the total corporate profit is 40,000. Executing that calculation yields an allocated internal profit of exactly 12,308 rupees for the packaging division. To find the final transfer price, the parent company must reimburse the packaging division for its 80,000 rupees in manufacturing costs, and then add that new 12,308 rupee profit slice. This brings the total transfer price for the 8,000-unit batch to 92,308 rupees. Dividing that total by the 8,000 individual units gives us a precise transfer price of 11.54 rupees per carton. Under this shared profit method, a division's financial reward is mathematically tethered to how much money they spent to complete their operations. Now consider the primary alternative, the market price method. This method abandons internal cost data entirely. Instead, it relies on the objective price and external vendor charges for the exact same cartons on the open market. This comparison ledger establishes that external benchmark. The current market price for an 8,000-carton batch is 95,000 rupees, which immediately becomes the internal transfer price. If that 95,000 total is divided by 8,000 units, the per-carton transfer price sits at 11.88 rupees. To find the packaging division's internal profit under this method, we subtract their 80,000 rupee manufacturing cost from the 95,000 rupee market transfer price. That leaves a clean 15,000 rupees in profit. The ledger directly contrasts the packaging division's reward under both systems, 15,000 rupees using the market method versus only 12,308 rupees under the shared profit method. The packaging division earns significantly less profit under the shared cost framework. The internal math actively suppresses their performance, and the underlying data reveals exactly why. To understand why the shared profit method yielded a lower result for the packaging division, we have to examine how costs behaved when the factory increased its output. These graphs compare per-unit costs scaling from 5,000 to 8,000 cartons. Packaging achieved massive economies of scale. Costs dropped from 15 to 10 rupees, a 33% reduction. Production failed to match this, falling from 24 to 22.5 rupees, just a 6% reduction. That discrepancy in cost reduction is the exact metric that breaks the shared profit formula. This pie chart is the total cost pool. Under shared profit, packaging's 33% efficiency shrinks their blue slice. Consequently, the orange production slice commands a larger percentage. Production free rides, securing more of the 40,000 rupee profit simply by spending more. Cost-based allocation models harbor a strict mathematical flaw. They punish cost efficiency by directly tying financial rewards to high expenditures. This mathematical proof translates directly into the formal theory required for evaluating cost-based transfer pricing on exams like SCMPE. SCMPE, or Strategic Cost Management and Performance Evaluation, is the advanced study of how accounting metrics drive business strategy. A cost-based model's primary advantage is operational, benchmarking division performance against internal targets. The disadvantage is subjectivity. Divisions dispute using variable, standard, or full costs. More critically, it actively disincentivizes cost-efficient methods among managers. To resolve this, companies sometimes use a marginal cost-based transfer price. Marginal cost is defined as the specific incremental expense required to produce exactly one additional unit of a good, stripping out fixed overhead allocations. Mastering strategic cost management requires examining the math beneath the surface. You must understand how an accounting formula's built-in biases manipulate human behavior, dictate internal strategy, and ultimately drive corporate efficiency.